Tesla's results last night. Shambles.
Yeah. Elon's might get some free stock.
Oh, funny that. You might get some
What do you think
cheaper
about
cars
that?
as well. I think Tesla's probably a whole episode of the pod, isn't it? I mean, it's an extraordinary business.
Yeah. Because he's basically said all of his other ideas will be done outside of Tesla if he doesn't get the free stock. So he'll just do it as an add-on to SpaceX or whatever else.
This is horrible, isn't it? But
yeah,
it's certainly watching with interest. How are we looking, Alex? Are we all right? Yeah, good. Sure. Get started?
Yeah.
You ready?
Yeah.
Good to go. Hello, everyone, and welcome to Taking Stock After the Bell, episode 24. Joined as always by esteemed colleague James Hughes from the Chile, as well as Head of Fixed Interest Research, Richard Carter. Richard has worked with Quilter Cheviot for over 6 years and has 16 years investment experience. In previous roles, he was a fixed income analyst and fund manager at Barings and BNY Mellon. Richard graduated from Leeds University with a BA in history and is a CFA charter holder. So welcome to the club.
Thank you.
Sorry, easy. Outside of work, Richard is an active member of his local running club, participates in a variety of races. He's widely read, with history and politics being his main interests. Richard is also the most travelled Quilter Cheviot employee there is, and the morning meetings are renowned for hearing of Richard's travel adventures. So welcome, Richard.
Thank you.
and football scores.
And
football
scores. And how is the electric car going?
Very well, thank you. Yeah, very well. Not a Tesla, but
Not a Tesla.
still doing pretty well.
Good. Well, welcome to the club. Now, being head of fixed income research, I mean, I joined Quilter Cheviot over 10 years ago, and it's fair to say for the first few years, we didn't really need to come and talk to you very much, for the simple fact that bond yields and interest rates were naught. Bonds were not that interesting. But, I mean, it's changed a bit in the last 2 years, is it?
It's changed hugely, and not just sterling. Sort of things we can do in euros and dollars and everything across the different markets has massively changed. So you can buy a bond, hold it to maturity, and it should beat inflation over that time, as long as inflation's relatively well behaved. So things have changed massively. I think there's a lot we can do for clients that we, like you say, we couldn't do for the last 10 years.
Just become an investable asset class again, isn't it? As opposed to something we kind of have to have in a bit of the portfolio.
Yeah,
where necessary.
Yeah,
it's real returns to clients.
Yeah. So we wanted to have you on to talk about not just the bond market, although that's interesting and an increasingly interesting area to talk to clients about. And I get very excited about bonds, way too excited. But also a bit on the macro as well, because we've got, are we having a recession? Are we not having a recession? Episode 1 of the podcast, we proudly proclaimed over a year ago that we were definitely having a recession. There's no way the world can withstand 5% interest rates. And that was over a year ago.
Lo and behold, they have withstood interest rates yet again.
It's been pretty extraordinary.
Yeah.
So we'll whiz through a couple of charts initially. This is the first one, which I think we show quite a lot actually on this pod and with clients. 30 years of inflation, it was always around 2%. The UK is here in blue, US in red, and Europe in yellow. And then it was transitory after all, wasn't it? That's what we keep talking about here.
It was transitory, but it got pretty
transitory.
It was quite eye-watering levels for quite some time. So I don't think I think if central bankers had been shown this chart 3 years ago, they would have been quite so relaxed as they sounded about inflation initially, right?
Well, they changed their minds pretty quickly, didn't they? From summer of 21.
They certainly did, and then they went really, and now almost we're in a flip side where inflation's coming down and they're saying, we can't possibly do anything, we can't reduce rates yet because our job's not done. But if you look at the chart, actually, it looks like their job is increasingly
What do you think inflation would have done if we hadn't increased rates as we had?
It's a really good question.
It's a really good question. It probably wouldn't have been coming down as quickly as it has done. But then you think about some of the things that were driving inflation. Energy prices,
goods prices, energy prices.
I mean, have central bankers kind of affected the price of natural gas? That's come down pretty sharply.
The housing market's probably the only thing, isn't it?
But house prices
haven't really fallen.
No, that's sort of my question is if they'd raise rates to, say, 2.5, 3. Yeah. I know that's not restrictive.
Yeah.
But do we think inflation would still be a Mount Everest.
It might still come down quite sharp anyway. The risk is, I guess, the bond market would have taken fright had they not raised interest rates.
That's very good point.
And you could have had bond yields, back up sort of 6-7%. And that could have tipped us all into a recession. So some ways they probably did the right thing.
That's fair enough. And then just before we move on from this, I mean, obviously they're sort of one of the talking points at the moment, I guess, is what's happening in the Middle East and the Red Sea. Container ships having to go around Africa as opposed to through the Suez Canal. Does that, I mean, container prices have gone up and there's been a few sort of rumblings from the sort of chief executive of Next and that sort of thing. Yeah. Is that a genuine risk to inflation this year, of a sort of resumption in, higher inflation rates later in the year, or is this at the moment just a blip?
I think it is a risk, but it's probably more a risk for the UK and Europe than it is for the US economy. The evidence so far is it's not affecting the US.
I guess they ship in a different direction.
They would go a different way. They would go a different way around from Asia anyway. So they've got less to worry about. I think it's probably it's out there, but it's probably less of a concern relative to maybe wages still growing at in terms of central bankers, wages still growing at 5, 6, 7%. That's probably the bigger risk for inflation.
The US, as we go back to again with Tim Marshall's book, The Prisons of Geography, the US wins again, doesn't it? Every event it seems to come out.
Energy independence.
Shipping issues through the Red Suez Canal it doesn't impact them. It's quite amazing actually.
Yeah. There's a list of really good reasons why the US is dominant as it is, which I think is an entire episode of a pod at some point. But
we've sort of done bits of it, haven't we? But it would be. Yeah, it would be good to do that.
But I guess gas prices is probably the only other area. There's some sort of talk of a Qatari ship heading to Italy that's been turned back or something today or something. I mean, is that, again, if gas doesn't get from Qatar to Europe, is that...
Yeah, that would be a concern, although we're in a way we're getting, we're quite a way through the winter now anyway, aren't we? I mean, storage levels are pretty high, the prices have come down.
It's 10 degrees today.
It's warming up. Is that
Despite
really...
Despite my gilet. It's cold.
That's why that risk.
So
I don't think it's a big deal.
Now as we sort of mentioned, really, I mean, central banks put base rates up to 5.5%, UK and US here in US in blue and UK in red, from naught after 15 years of zero rates. If we sort of move on, this is US and UK GDP going back 15 years or so. The US this time is in orange and UK in grey. Clearly we had those big spikes around the pandemic where the numbers were all messed up by switching the economy off and on again. But so far we've not had negative GDP as yet. So the question is, the chart is, where is the recession and why didn't we have one?
Well, I think
are we going to have one yet?
I think we need to differentiate a little bit between UK, Europe and US. I mean, the US was not as affected by the energy crisis as maybe Europe was. And there was a massive government stimulus during COVID, so that consumers built up huge amounts of savings, and they've been able to spend that for the last year or so. So that's really kind of kept the economy going, right? And at the same time, the unemployment rate's been very low, so most people have been at work, and that's meant we've avoided a recession. Also, don't forget, these higher interest rates, they don't feed through to everyone at the same pace.
No. So if you're Husey, you're fixed on your mortgage for 10 years.
If you fix your mortgage at 2% for 10 years, you've got nothing to... What's the problem?
I'm just giggling about Dave as usual. Poor Dave. He'll be listening to this, and I'll get a text over the weekend to say thanks for referencing me again. But he did. I think last pod we said he'd fixed at 6, but actually he's on a floating.
So
he is enjoying. Well, not enjoying
yet. He's
yet.
Enjoying 5.5% interest rates. And I'm not going to kind of touch on the data, but it's the unemployment rate here in the US and UK. US in blue, UK in red. Obviously in the US they have no employment law basically, so you can sack anyone on the spot, which is why in the pandemic the unemployment rate got to 18%. I cut the top of the chart off because it just looked ludicrous. But it's ticked up a little bit, right, but not a great deal. I guess we're slightly guilty of being in the kind of southeast London bubble a little bit. I had some clients in yesterday morning who travelled in from another part of the UK, and they were like, London is packed. There is absolutely no recession here whatsoever. Everywhere is busy, everything is expensive, it sort of feels like it's booming. Maybe that's not the case if you look across the UK as a whole.
And were they saying that's not the case at home?
Yeah. But certainly the economy continues to tick along, and the data this week has been pretty good, right?
Yeah, I mean, UK surprisingly resilient, really. I mean, we had PMIs this week, which are, you've got to look at them over a longer term rather than worry about one or two. But they're still pretty resilient. They're not saying there's a recession on the cards, and they are not saying, "Come on, we need to cut rates tomorrow." Basically.
And what would you be looking for if we were heading to a recession? What would be the things that would be the red warning lights or
rising unemployment rate?
Right.
I mean, I know people say it's a lagging indicator, but I think everyone looks at it so much, and central banks look at it. And at the moment unemployment starts going up, you start to worry about retail sales, you start to worry about confidence, start to worry about everything, right? Corporate profits. So that's the thing I think really to watch. I mean, there are leading indicators, and there've been various reports out about insolvencies and all the rest of it. But I think unemployment is the one where really everyone starts to kind of believe this is an issue.
Yeah, I guess if you work in a firm and the firm decide to lay 10% of the people off, not only have 10% of those staff decide to rein in, the other 90% are like, it'll be me next round. We need to start saving. Yeah. So
I mean, I think you're seeing it on the trains because, there have been some cuts across the city. But I tell you, I get on a train on a Monday or a Friday, and I'm struggling for a seat again. Whereas I think 3-4 months ago, you'd sort of look around to try and find someone on the train. I do think, I know there's been talk of some companies pulling workers back and saying, you're not as collaborative from home and the rest of it. But I do think there is that fear factor amongst employees. I think the control has coming out of COVID, I think employees sort of had the control, the power.
Definitely.
Yeah, exactly. And I think that's now switched, and employees are thinking, God, 10% of the workforce has been laid off. My boss really needs to see me every day in the office. But,
so you're not the one.
So you're not the one.
Well, wage growth is still pretty firm.
Yeah, it is, but it is slowing, but it's still above the rate of inflation, right? So I know people have been through a really tough time the last few years, and taxes are high and everything else, but actually now wages are growing quicker than inflation. Yeah, which might not last for that long, but it should last for the next 6 months.
There's always going to be a lag, isn't there? Because if inflation was 10 and you got a 5% pay rise, and inflation is now 2, you still want a 5% pay rise because you're still trying to get back your lost income.
Yeah.
So there will always be an element of lag. Again, it comes back to this power point about inflation is about power ultimately between labour and capital.
100%.
Yeah. So there's no recession as yet, but we need to watch unemployment. I think is the takeaway from that. Right?
And in terms of the cuts that might come, or certainly the market's pricing in a number of cuts this year for both US and across all developed markets, well certainly US, UK, and Europe.
Yeah.
From what I think historically bankers are late to cut, aren't they? And when they do cut, they tend to cut by a decent chunk because they're in panic territory.
A lot. Well, you can understand it because they were too late to raise rates with inflation rising, got that wrong, and then the last thing you want to do now is go and cut too early and have inflation spike back up again. So they've got to be careful, and so you're going to hear them for the next at least, I think, 3 months. I know we had a so-called dovish pivot from the Fed, but I don't think the other central bankers really haven't changed their tune at all. So I think they will be a bit slow to cut rates, which increases the risk for the economy. Particularly in Europe, where we sort of say, "Where's the recession?" Well, look at Europe. I mean, it pretty much is in recession. Yeah. So, the pressure will build on them to cut rates, but I think at the moment they're gonna wait. And then once they get going, who knows? Yeah, they could have potentially cut quite aggressively. I mean, rates are high, so there's plenty of room.
So we've got the chart here of what the market thinks the rates in the UK and the US are going to do. And if we look at the blue and the red line, well, they're both at the same, don't they? So December 24, around the middle of the chart, what's that, 4.5? So what, 3 or 4 cuts by the end of the year?
I think, I think UK's pricing in about 1% of cuts by the end of the year, and then US is slightly more. But it's there or thereabouts. I think Eurozone is sort of fairly similar. So, I mean, it's going to be, you're right, the lines are absolutely pretty much bang on top of each other for most of it. And Europe, albeit the rates are lower, it has a similar sort of trajectory. So we'll see if they all move together. I suspect they probably will pretty much all move together.
But this is the sort of the epitome of the soft landing narrative, isn't it? Central banks can cut by 1% to 4.5% this year and get away with it. Well, I look at this chart slightly differently, and I say, well, if the market average is for 1% of rate cuts. That means that some people think they're going to stay at 5,
Yeah.
if not go up
Some
again,
people think,
and some people
yeah,
are going to go to 3 or
yeah.
2 because we're going to have a recession.
Yeah.
So I think, it's this soft landing narrative that everyone seems to think is consensus. To me, I don't think that's quite right. I think that there is a core of people who think higher for longer, inflation will be sticky. Maybe the Red Sea blows it up again, which makes life difficult for central banks. And the other half think we're going to have a recession. And therefore rates are going to 2.5, 3.
Yeah.
And I've heard both cases. You probably listened to Brevin Howard yesterday, weren't you? There was a podcast with chief economist of Brevin Howard last week, and he's definitely in the rates back to 2.5% by the end of this year camp.
I mean, it's odd that a macro fund is predicting the end of the world, isn't it?
Isn't it? Yeah, buy some bonds. So I just think it's going to be really interesting. And do you know what? I genuinely don't know which of those 2 scenarios that I believe the most.
They're not, markets aren't pricing in super low rates. That's for sure. I mean, they are pricing in, they're coming down to more reasonable, to lower levels, but they're not pricing in a sort of deep recession and coming down aggressively, which is a bond person kind of, I guess, gives you some optimism about potential returns in a bad economic scenario.
I mean, has the Fed talked about where they think the neutral rate is?
It's always in there. The dot plot has a rate in there. I think it's 2.5-3% or something like that. But there'll be some debate about that if inflation stays very sticky and the economy stays pretty strong. Maybe those forecasts will change. I don't get too carried away on what these long run estimates of where. It's just
that's niche content, right?
You've got hundreds of pages of academic work on this sort of stuff if you want to go read it. But I think I tend to think where rates are going to be in the next 2 to 3 years, and what's the economy going to be doing, and that's kind of more important for bonds. These long run estimates are they're difficult to get a handle on sometimes.
Now, moving somewhat neatly onto bonds. When interest rates go up, bond prices go down, right? So the last 15, 18 months, the top pane of this chart here is the UK 10-year yield, which you can see in August 2020 was basically 0.1, I think it bottomed out. And it went from 0 to nearly 5 6 months ago. And the bottom pane here is the price of the 2036 gilt, which pays a 4.25% coupon. And we can see that the price of the gilt was about 160 at the peak when yields were on the low, and the price of that gilt fell to 100. So it fell a good, 30-40%.
Yeah.
Now that's quite painful if you're a bond investor, right?
Very, very much so, depending on where you bought the bond in the initial case. But yes, very much so.
So just this idea that when yields go up, if you already own a bond, the price goes down, and obviously vice versa, as we can see in the first half of the chart. As yields fell, the price of that bond did pretty well. So what the chart sort of says is that you want to be buying bonds when yields are going down, right?
Yeah, when yields are high above inflation, ideally, and falling. I mean, obviously, it depends a little bit if you're planning to hold it to maturity, or where your return's a bit more fixed, or you're going to sell it into intervening period. It also worth mentioning about duration and sort of maturity. The longer the maturity of the bond, the bigger impact those yield rises have on the price. And 2036 is obviously quite a long way out. It's going to take you a long time to get your money back. Yep. So the impact on the price was pretty pronounced.
Pretty pronounced, yeah. So,
but what's it? 10 years? What today? 4.5 ish.
But 4 in the UK, but slightly below 4.5. But so it's okay. Inflation's coming down, and 4% is not bad. But bond markets have had a pretty bad start to the year because back end of December there was massive rally. Pricing in huge amounts of rate cuts, and those have been sort of
I mean, this is what clients often ask me. I think for clients getting their head around prices, bond prices and yields and the direction, if you don't sit in it every day, is actually kind of fairly complicated. But sort of clients often, a few clients recently said, well, if rates are coming, then surely, we should have duration. But it's trying to explain actually how much of that duration is already priced in. So as you say, obviously 10-year treasuries are slightly higher than gilts at the moment, but 10-year gilt is, as you say, a bit over 4.
Yeah.
So that it's actually already, the yield is already, or the gilt yield is already anticipating
discounting those rate cuts.
Some of those
Absolutely.
rate cuts.
Yeah, it is already discounting some of those rate cuts. So you've got to think. Are they too? Is that too many? Is going to be more coming? All those kind of assessments about it. But also, you can think, look, in a day, it's 4%. Do I think 4% is a good level? If I think inflation is going to be 2.5, it's 4% on a. It's not AAA, unfortunately, but on a government bond, which should be sort of vaguely AAA behaviour. Do you think that's good? Well, it's hard to say, but it's downside better than it was at 1%, and it got close to 5 or 5. But
so we've got the charts up here of 10-year government bond yields in the UK and US. Again, UK is in blue. The gilt yields at 4 and a little bit higher in the US. We have to go back to 2008, back in the days when James had hair, to get a 4% yield.
It was thinning in 2009.
Yeah.
I think by 2009
my investment career has seen, my entire investment career, bonds have had yields, UK gilts have had yields lower than 4%. For most of it, it's been sub 3, and for a large part of it, it's been 1 or below. So, to come back to the point about you not being particularly popular for most of the 2010s, well, that's because why are we going to buy these things for clients when the yields are 1%? Today, it sort of feels like when we're sat with clients, the traditional kind of cautious private client who wants a steady 4-5% return with they don't want to take a huge amount of equity risk because they don't want to see the front page of the Daily Mail with stock market meltdown on it. All of a sudden this asset class now, you're right, if inflation stays at 2 to 3%, then 4% on a risk-free asset ultimately, because you're going to get your money back from the UK government, looks pretty good, isn't it?
And the moment central banks start cutting rates, I know quite a lot priced in, but it changes the kind of whole narrative. Suddenly people go, well, wow, 4.5%. If you get 30-year gilts, you can get 4.5%. People go, that's not going to be around for very long. I need to start buying it. And there's a lot of money sat in money market funds at the moment, which are still yielding sort of base rates of about 5.25. At some point, if when those returns on those, the yields on those will come down as the Bank of England cuts rates, and I think you'll see money come out at that point.
I think we've had those conversations with clients as well, who've all sort of boasting about 5% in the building society.
It's not there forever.
Is it going to be there in a year's time when your 1 year fix rolls off? What are you going to be refixing at? Whereas you can buy a 2-year gilt today at 4.5 or whatever. You can lock in some of these yields on some of these.
But also the 5.25 hasn't actually been there for that long. I don't know what was the average rate in the UK last year, because we started the year at.
I think the average money market fund probably did about 4.5%.
Okay, actually that's a bit
so
higher
it
than I
did okay. It did okay actually.
But it's just sort of interesting that a whole area of an asset class that we've not really had much interest in for 10 years now all of a sudden is super interesting. We don't have any charts here, but we can buy UK investment grade. In fact, we do have the chart. Sorry. So the chart here shows the spread or the additional return you get on investing in sterling investment grade corporates, i.e. the likes of Unilever and Shell and BP and good quality companies. You're getting an extra 101.4, 1.5% over. So that's nearly 5.5 to 6% yield. So 6% yield on some kind of Shell or Unilever bonds is pretty attractive, isn't it?
And actually, we're saying it's not just a sort of call on the UK economy, because a lot of the issuers in sterling are. Multinationals. They might be as likely to be JP Morgan, Walmart, as they are. They're not. You're not going to be buying
AT&T,
UK domestic companies. Absolutely. So you have a mix in corporate bonds, investment grade. A lot of banks in there. Utility companies, housing associations. But if you can buy a corporate bond fund yielding 5.5%, 6%, or a basket of corporate bond names yielding 5.5%. It's not a bad return, is it?
Do you think spreads are? Do you think they've tightened too much based on potentially slowing economy, recessionary pressures?
Yeah, if we go into recession, for sure. I mean, they are pricing in a soft landing, a benign soft landing environment.
So what do spreads potentially go to? I mean, I know
you've got to keep an eye on the banks, because the financials as a part, it's a bit slightly different to the equity markets. The financials, when you look at what big weight they are in
huge,
sterling, it's about 40%.
They're 40%.
And there's all sorts of different parts of that subordinated bonds thing.
18
So
months.
you've got to keep
It's high in the global basket.
It might be a bit lower in global, but not
Still
far off. Not far off. So if you see a financial crisis or banks get into trouble, that's where you get real blowout in spreads. Because you mentioned Unilever. How bad are they going to do in a recession? They're still going to pay their bonds, aren't they?
Yeah.
So so you've got to be a little bit careful on that. But I mean, spreads can blow out to 2%, 2.5%. But this is investment grade at the end of the day. Most companies will make it through any recession.
Yeah.
And then if we go further down the credit spectrum, so instead of buying investment grade, we can buy kind of junk / high yield. What are the sort of returns available there? And is that, absent a recession, is that you getting decent pickup in yields?
Yeah, so we haven't got a spread chart on that here, but you might get 4.5% on high yield names, so sub-investment grade. So 4.5. Well, listen, the UK high yield market is pretty small. Okay. When we talk about high yield, we're mainly talking US and Europe. Okay. So you might be getting, for example, 4.5% over treasuries, so you might be getting 7.5%, 8%, which is pretty good. But clearly they are growth sensitive names, and just as Unilever make it through in a bad recession, some of the companies in there might not.
No. And then just on a sort of managing a fixed income portfolio, you've got basically, it sort of seems to me you've got duration, i.e. how longer dated bonds do you want to buy versus credit risk. Do you want to buy UK government, US government, or do you want to buy Unilever, or do you want to buy Mr. Speculative company that's not likely to pay you back? Yeah. What are kind of managers saying about where we should be? I mean, is there a sort of divergence in views of you should be short duration because yields are staying high and going higher, or?
It varies, because a lot of these external managers with their funds, they're pretty limited on what they can do. They might be governments only, they might be corporates only, or have limited flexibility. Those who've got a bit more flexibility, for the last year or two, they've been bumping their duration up. So it's hard to give an average because it will depend, but sort of 6 to 7 to 8 sort of years kind of area. And generally, people have been paring back their corporate exposure in favour of sovereigns. But that's quite general, because it will depend on the
And is that because of narrowing of spreads?
Narrowing of spreads, because yields are higher, and yields are high, so you bump the duration up a bit. Spreads are narrow, so you reduce the corporates a little bit. That's the general.
I guess the other reason spreads are so tight is actually, I think, a lot of companies did a cracking job through COVID at refinancing and sorting out their balance sheets and fixing debt for the long term. It's I got told by John for saying this, I think, the other day, but you look at some of the very best corporates and their balance sheets look in much better shape than some sovereigns out there. I know it's very different because a corporate can't print and the rest of it.
Yeah, absolutely. Well, you can buy corporates with higher ratings than the UK government, but Microsoft, for example. But absolutely, a lot of them are in pretty good shape.
I mean, finance directors on the whole have done a really good job. Yeah. And I think you've probably seen less pain during this period of rates hiking because of the they're kind of unsung heroes in a way in terms of how good some of these finance directors did.
We're going back to why no recession.
I was going to say exactly that.
High rates, but doesn't seem to have impacted a lot of sectors.
It's the corporate equivalent of if you're usually fixing his mortgage for 10 years, right? When rates were low.
Well, quite a few of them were on the phone to me saying, James, what should I do?
You seem to know what the crack is, what's going on, what should we be doing? No, I think it's really interesting, and we've at the margin put more money into bonds as yields have gone up, and we've talked about that in asset allocation and as our sort of headline strategy level, and sort of feels quite exciting, and equity markets look fine, and equities will do okay over the medium to long term, and we can probably argue there's areas that look too expensive and there's areas that look cheap, and there always is. But there is more of a certainty of return in the bond market.
And the other thing, we haven't had a full year of these sort of high returns and what bonds are giving us. As you go forward a year, 18 months, actually the returns from these areas are going to really start pulling their weight in terms of total portfolio performance.
You'd hope so.
In the long term, balanced strategies probably returns 7-ish. If you're getting, you're fours on your kind of sovereign debt and 5.5, 6 on corporates. That's doing a really good job towards total performance.
And we all talked about return. it was talked about the death of the 60-40, kind of 60% equities, 40% bonds portfolio.
Yeah.
Well, when yields were naught, that's probably right.
Yeah.
But when yields are 4-5,
Yeah.
that's definitely not right. If anything,
No.
we should be putting, it's the other areas of the portfolio that we've gone to in recent years to try and hide away from bonds. It's probably going to be as far as I can see, the area we take money from.
Can I actually, something we've talked about before is how correlated bonds and equities become, and what's your take on when does bad economic data become bad news, and when does the 60-40 actually start working how it has historically worked in terms of uncorrelation?
Yeah, when people tend to talk about correlation with bond markets, they tend to be government bond markets. Actually, if you've been buying high yield can behave differently to government bonds and corporate bonds. And all
That's
the
very
rest
good point.
of it. So it's not, so if we have a nasty recession, and banks are in trouble and all the rest of it, your government bonds probably do very, very well. So at that point, they do plug to the
That's when,
recession. But you don't want to be in high yield bonds at that point. So you've got to be a little bit careful about what we're talking about. But I do think there is clearly that everyone's hanging on the Fed's every word and pivot and diagram, dot plots and all this sort of
Speeches,
stuff. And it does the speeches, the minutes, and it does affect everybody's. It does affect all the markets, and that is, there's no getting away from that. But all I would say is with yields at 4.5, if there's a nasty recession, your government bonds are going to do pretty well.
Yeah.
Not everything else will.
Yeah.
But if you get a few more of these kind of supply chain driven inflationary episodes like we've had, then that's when the bond market and the equity market remains correlated as it was in 2022.
Yeah.
And that's probably quite difficult for us to manage as portfolio managers for clients.
Yeah, I mean, again, it goes at that point. You probably want a very short duration corporate bond, investment grade corporate bond yielding 5.5%-6% because that's going to do fine.
Yeah.
Your longer dated bonds, no.
Well,
and I guess that's the thing, isn't it? You think about rate cuts coming, you add your duration, but as you say, you get inflationary spikes, and suddenly the duration hurts you. Equities sell off because you might have some inflationary pressures, and that's as you say, that's as John says, that's difficult to manage. But then we do have access to some really good managers who do run short dated corporate bond strategies and
cash.
Yeah.
Market funds.
Yeah.
And some clients say cash weightings in portfolios are probably a bit higher than they have been.
Yeah.
But clients are getting paid to own cash. And so clients say, well, why have I got so much cash? Well, you're getting paid for it. Yeah. And it's a useful asset to own in a somewhat volatile world.
We saw Lloyd just before Christmas, and he'd been shortening some of his duration. So that was he tends to run that slightly short. So that's done. That's kind of a position we would have to try and protect us on that side.
But I think certainly that the opportunities are definitely much better than they were for most clients, and that's quite a refreshing change. And it means that you're a bit more in demand, aren't you?
Absolutely. Long may it continue.
Long may it continue. Now, as our kind of resident political expert, it would be remiss of me not to ask about politics, because we've got a long year of this, I'm afraid. So we're going to presuming the UK election is pretty.
We're going in early, second pod of the year.
Yeah, we are,
I think people are more interested in when the election's going to be and the sort of UK-US timing.
Does it matter when it is?
It doesn't, but I think because the UK election is a complete foregone conclusion, or so.
You heard it first. Like the recession. Foregone conclusion, right?
And then the US one, we don't know who the candidates are yet. Although we think we're increasingly getting to the state it's going to be Biden, Trump.
I think the UK is going to be. I'm not going to sit here and say it's going to be a different result to what the polls are saying, but I think it's going to be a lot tighter than the polls are suggesting. There's a lot of seats to turn.
There's a long way to go.
And I think, there's a long way to go.
But the US, I mean, what do financial markets need to worry about in terms of Biden versus Trump?
I don't think they need to worry too much about Biden versus Trump on a sort of 2024 scenario. I don't, much as people might not like Trump, probably if you're thinking about his impact on the US economy, it's probably not negative at all.
No.
I think the worry is more 2025 geopolitical,
withdrawing support for
Ukraine, that sort of side. What do they do with the Chinese in terms of trade policy? That's probably where people have got a concern. I don't think, to be honest, the UK election, interesting though it will not be a big driver of global markets. I don't think.
No, not. I mean, I remember the 2016 election, and for reasons I won't bore you with, I was lucky enough to be in the US Embassy during election night when Trump was a very shock win, and it was the atmosphere in that place was wonderful that night. The equity market sold off 4-5% on news of Trump winning, and then within 3 to 6 months it ripped 15-20% higher. So again, it comes back to this point, and not dissimilar to Brexit in a way with the FTSE. Like, initial reactions of market participants are not always the right ones, are they? So
I mean, if Trump does get in, is there a chance that he might have learned his lesson? He might actually not be quite as strong on certain things he was in his last term. What do you think?
Even worse.
I
think it was his vindication that he was right in the first place. I think.
Do you think so? You think he'll be as strong?
I worry greatly about the direction America's heading in, what it means for European policy, defence, and all the rest of it. But I'm afraid, but as far as the economy is concerned, it's probably not such a big concern. But defence manufacturers might be, with European clients, might be doing quite well.
I think we're going to have a kind of year of it, and the geopolitics. We had Dario Perkins on last year, didn't we? The world certainly feels a bit more volatile and a bit more. That sort of post-Cold War peaceful era might be getting behind us, which I think, I don't know what it means for portfolios other than we've just got to do the basics and be diversified and try and kind of shore things up a little bit. And again, we can't, the things that hurt markets are not always the things that are obvious in hindsight. We can talk about, are we going to have a recession or are we going to have more inflation from the Red Sea? I mean, it's not, it might be something else altogether that we've not thought of that's going to hurt us. So we need to stay sort of...
Well, I mean, the things we're worried about, the things that are in front of us, and typically that's been priced in. It's the events that we haven't thought about because they're unpredictable and impossible to predict. That
there's some sort of Donald Rumsfeld quote in there somewhere about kind of the
unknowns.
The unknown unknowns is what gets us. So I think on that cheery note, other than reminding ourselves that we can get 4, 5, 6% on bonds, and we're not going into a recession after all, and inflation's coming down, and things are pretty good. Should we call it a day? Have we got anything else? Happy with all that?
Nothing from me.
Yeah,
excellent,
great.
That was great.
Well, thanks so very much for joining us. Any questions? Then get in touch. James.hughes@Cheviot.com, or I'm Jonathan.Raymond@Cheviot.com. Thank you to Richard for joining us, and we'll see you next time. Richard. Thanks very much.